In the complex world of finance, credit default swaps, or CDS, stand out as both intriguing and intimidating. Simply put, a CDS is a type of insurance against credit risk. Imagine a bond issued by a company. You, as an investor, are concerned that the company might default on its debt payments. This is where a CDS comes in. A CDS acts like a safety net. You pay a premium to another party, typically a financial institution, who agrees to compensate you if the company defaults. In essence, you are transferring the credit risk from yourself to the CDS seller. This ability to manage risk is what makes CDSs a fascinating tool. However, like any financial instrument, CDSs are not without their complexities and potential downsides. Understanding these nuances is crucial for anyone looking to navigate the world of credit default swaps. This essay will delve deeper into the mechanics, applications, and risks associated with these instruments. Credit default swaps have two primary uses: hedging and speculation. Hedging involves mitigating potential losses on an existing investment. For example, if you own a bond, you can buy a CDS on that same bond to protect yourself from losses if the issuer defaults. Think of it as buying insurance for your car. You hope you never need it, but it provides peace of mind in case of an accident. On the other hand, speculation with CDSs involves betting on the creditworthiness of a company or entity. You don't need to own the underlying bond to buy a CDS. You can simply purchase a CDS if you believe the credit risk of an entity is going to increase, potentially profiting from the rise in premium payments. This speculative aspect of CDS has drawn both praise and criticism. Proponents argue that it adds liquidity and efficiency to the market. Critics, however, worry that it can lead to excessive risk-taking and market instability. The 2008 financial crisis highlighted the potential dangers of unregulated CDS speculation. Just like any insurance policy, a credit default swap comes with a cost: the premium. The premium reflects the market's perception of the credit risk associated with the underlying entity. The higher the perceived risk, the higher the premium. Think of it like car insurance. A driver with a history of accidents will face higher premiums than someone with a spotless driving record. Similarly, a company with a shaky financial situation will have higher CDS premiums compared to a financially sound company. These premiums are typically paid quarterly by the buyer of the CDS to the seller. The spread, expressed in basis points, is a key metric in pricing CDSs. For example, a spread of 100 basis points on a CDS means the buyer pays an annual premium of 1% of the notional amount. Understanding these pricing dynamics is crucial for investors looking to utilize CDSs effectively. While credit default swaps offer a way to manage risk, they also come with their own set of risks. One of the most significant is counterparty risk. This is the risk that the seller of the CDS, the party who promises to pay in case of default, might be unable to fulfill their obligation. Imagine buying car insurance from a company that goes bankrupt when you have an accident. Your claim might not be paid. Similarly, if you buy a CDS from a financially weak institution and a default occurs, you might not receive the promised payout. Apart from counterparty risk, there's market risk. The value of a CDS can fluctuate based on changes in credit spreads and overall economic conditions. Lastly, liquidity risk is another concern. This refers to the potential difficulty in selling a CDS quickly at a fair price, especially during times of market stress. Understanding and mitigating these risks is paramount for successful CDS investing. Section 5. Reining in the risk regulatory landscape post-2008. The 2008 financial crisis exposed the vulnerabilities of the financial system, including the unregulated nature of credit default swaps. The lack of transparency and oversight in the CDS market played a significant role in amplifying the crisis. In response, regulators globally implemented reforms to bring greater transparency and stability to the financial system. In the United States, the Dodd-Frank Wall Street Reform and Consumer Protection Act, enacted in 2010, brought significant changes to the CDS market. The act aimed to push standardized CDS contracts onto regulated exchanges, thereby reducing counterparty risk. The Dodd-Frank Act also established central clearinghouses for CDS trades, adding another layer of protection against defaults. These regulations, while not eliminating all risks, have made the CDS market more transparent and resilient, offering greater protection to investors and the broader financial system. Section 6. Institutional playground or retail opportunity, accessing CDS. Credit default swaps are predominantly used by institutional investors such as hedge funds, banks, and insurance companies. These sophisticated investors utilize CDS for hedging their large portfolios or taking calculated bets on credit movements. The complexity and often large notional amounts involved make CDS less suitable for the average individual investor. However, retail investors can gain indirect exposure to CDSs through exchange-traded funds, or ETFs. These ETFs track indices that include CDS, providing a more diversified and accessible way to participate in the credit market. It's important to note that investing in CDS ETFs comes with its own set of risks, and past performance is not indicative of future returns. Retail investors should carefully consider their risk tolerance and investment goals before investing in any CDS-related product. Professional financial advice is always recommended. Section 7, Measuring Credit Risk, the CDX Index and its composition. Navigating the vast world of credit default swaps requires reliable benchmarks. Enter the Credit Default Swap Index, or CDX. This index, managed by S&P Global, tracks the credit default swap market in North America. It serves as a key barometer for the overall health of the credit market. The CDX comprises a basket of 125 equally weighted CDS on North American companies. These companies are categorized into investment grade and high yield, reflecting different levels of credit worthiness. The index rolls over every 6 months, updating its constituents to reflect the evolving credit landscape. The CDX provides investors with a standardized and transparent way to track and manage credit risk. Its performance is closely watched by market participants, as it offers insights into the perceived creditworthiness of corporations and the overall direction of the economy. Section 8, U.S. Sovereign CDS, a barometer of fiscal and political health. Even the mightiest economies are not immune to credit risk. The United States, despite its economic superpower status, is no exception. U.S. sovereign credit default swaps, or CDSs, allow investors to hedge against the unlikely but still possible event of the U.S. government defaulting on its debt obligations. The price of these CDS, reflected in their spreads, provides a fascinating glimpse into global perceptions of U.S. fiscal and political health. Events like contentious debt ceiling debates or political instability can rattle investor confidence, leading to a rise in U.S. CDS spreads. For instance, in recent years, concerns surrounding political gridlock and rising national debt levels have contributed to periodic spikes in U.S. CDS spreads. While these levels remain well below those witnessed during the 2011 debt ceiling crisis, they serve as a reminder that even the world's largest economy is not immune to credit risk perceptions. Section 9, a historical perspective, CDS, and the 2008 financial crisis. Credit default swaps, once a niche financial instrument, gained notoriety during the 2008 financial crisis. The crisis exposed how the unregulated use of CDS could amplify risk and contribute to a systemic meltdown. Prior to the crisis, CDS were traded over the counter, lacking transparency and central oversight. This allowed for excessive speculation on mortgage-backed securities, with disastrous consequences when the housing bubble burst. The interconnectedness of the financial system through CDSs meant that the default of one institution could trigger a domino effect, bringing down others. This painful lesson led to calls for greater regulation and transparency in the CDS market, ultimately resulting in reforms like the Dodd-Frank Act.